So how does real estate work with taxes? There's two ways: active income and passive income. Active income is when you go to your W-2 job, you're a wholesaler, you're a broker, you're an agent. That's active income. Passive income is real estate. It's when you're really making money while you sleep. Those two do not offset each other. So remember, the goal of taxes is to make sure that you make as much money as possible, but you take all the deductions allowed and you play the game, so your taxable income is as small as legally possible. And we can do this with real estate. There is a short-term rental loophole, which I'm going to walk you through an example of how we saved our client $85,000. But I want to teach you, not get into a lot of detail because you guys will get bored. Remember that these things I'm telling you is for your knowledge, and this is what you should bring to your CPA. I don't expect anyone to know all of this and just become CPAs, but you should have knowledge on this so then when you talk to your CPA, they understand what you're trying to do. The only way that you can actually take passive losses, meaning you invest in a syndication or you buy a commercial building and you depreciate it, take it against your W-2, is if you qualify for this little thing we call real estate professional status. I'll call it R.E.P.S. What does that mean? You have to pass a test. Here's a test that you have to pass. I'm going to give you an example because I always think that's easier. Let's say you work at Chase and you make $200,000, but you're sick of the rat race. So what you're going to do is you're going to go buy a multifamily apartment building. You're going to depreciate and you're like, great. Now all this depreciation, I'm going to take it against my W-2 of $200K. I'm going to pay less taxes. That's not going to happen because you do not qualify for real estate professional. How do you get there? Nearly impossible. Not going to bore you with court cases. Very, very impossible for you to do this if you have a full-time job. The best clients are those who are married. One of them is a real estate professional and the other person is a W-2 earner. So if you're single and you work at Chase and you don't have anybody else, you're not going to be able to qualify for this. But remember that when you invest in real estate or in anything else, you shouldn't be doing it for the tax advantages. That is just a cherry on top. How do you get R.E.P.S? Number one, you have to pass both tests. So if you don't even pass test number one, don't even worry about test number two. Test number one, you have to work more than 1.5 times in a real estate trader business. What does that mean? That means if you work at Chase for 2,000 hours, you have to prove that you work 2,001 hours in your commercial building. Impossible. You'll never be sleeping. It's not going to work. People have tried it. The IRS is not going to let you do it. But let's say you're a realtor. Let's say you are raising capital and that is your full-time job. Let's say you own a property management company. You qualify for test number one because that's one of the trades that qualifies for real estate professional service. But after that, you still have to materially participate in your rentals, meaning you still have to go out and actively manage your properties. Like I said, if you have a W-2 and you don't, and you're not married, it's really, really impossible to do this. Now, if anybody knows me, I like to not bend the rules, but I'm really, really close to the line because that's what tax is like. This is something I don't. And the reason why is because it's very highly litigated with the IRS. If you think about it, imagine if the IRS allowed this for everybody, they would never get taxes, right? Because everybody would depreciate all their buildings and they would never get any of their revenue in taxes. So this is something that, one, is highly litigated and you really need to have really good records for it. A lot of people or my clients are like, oh my gosh, I lost my receipt for Home Depot. I'm like, I don't really care. Do you have a time lock for R.E.P.S? They're like, no. Okay, that's the issue, not the missed receipt from Home Depot. Now, there's a loophole for anybody out there who wants to take the advantage of this. It's called the short-term, well, we call it the short-term rental loophole. This is when you work for Chase and you're like, I'm sick of paying all these taxes. I gotta figure something out. Short-term rental loophole means you go out and you buy a building that you're going to short-term rental on Airbnb or VRBO. You don't have to pass test number one, you only have to pass test number two. So therefore, it's a lot easier because you can still work at Chase and you can still manage your Airbnb, make all that money, take cost segregation, again, we'll go into detail of what that is, and lower your taxable income as much as possible. When I talk about all these losses, I talk about depreciation. Depreciation really is just a phantom expense. It's really a non-cash expense that the IRS says, hey, if you have rental properties, we're gonna give you this expense. You need to take it. So how does it work? If you buy a commercial building, you're going to get a write-off. You're going to depreciate it over 39 years. So you're going to take, it's not as easy, this calculation, but like to make it simple for you guys. If you buy a commercial building for $100,000, you divide that by 39 years, and that is your write-off for depreciation. That gives you nothing. I mean, you're gonna take 39 years to take that. I mean, that expense is gonna give you nothing. So if you don't know, cost segregation is huge. So you guys remember on my first slide how I talked about the updates of it now being 80%? Here is where it's really important. Because last year was the last year that they did 100%. So what does this mean? Cost segregation, there's gonna be a firm that comes out to your building and starts looking at your building. They're gonna look at the building in different asset life classes. They're gonna say, okay, the cabinets are 5 years, the kitchens are 5 years, anything that is 5, 7, 15, again, you don't need to know all this, they're gonna do this for you, is going to be a write-off of 80% the first year. So imagine last year it would have been 100%. It's a significant amount of money when you're talking about hundreds, millions of dollars of buildings. So it's really important that you keep in mind how these rules start affecting you if you are interested in being in the quadrant of being an entrepreneur / real estate investor. So cost segregation allows you to take a bigger write-off the first year. This year 80%, next year 60. Another example people see on social media is like the cars, right? Everybody's talking about buying a G-Wagon because it was over 6,000 pounds and they were able to write it off. Yep, you go buy your 250,000 G-Wagon, whatever you want. If it's for the business, you get a $250,000 write-off that year. This year is 80%. But you gotta play the game, right? You can't just go buy a car. You gotta figure out what you're gonna do next year. So I'm gonna show you an example now of how we saved our client this. So our client made about $880,000 in W-2. He decided, hey, I'm gonna go buy a rental property up in Door County. Didn't work with a tax preparer who was actually well-versed in the real estate world. So they just took straight depreciation. So as you can see, their taxable income was $748. So look at the second. The first column will show you if he just worked at W-2, never knew anything about real estate, was never at these conferences learning, his tax was $252,000. Bought a rental property because he heard it somewhere on social media. That's exactly what he told me, so I'm not making that up. His tax due was $213. Then he came to me, I'm like, hey, Mitch, did you do a cost segregation? He had no idea what it is. We did that cost segregation that I was just telling you about. It was 100% last year. His tax went from $252,000 to $168,000. So the power of cost segregation is huge. Another thing that you need to know about cost segregation and losses on your taxes, a lot of people are scared. I don't know where my bankers are at, but they're like, oh my gosh, I'm not gonna get approved because I show losses. Depreciation gets added back to your income, so you don't have to worry about that when it comes to lending. And I know they were talking about other ways of financing, so that's not always the worst thing. But that's a huge thing that his CPA did not know about. He didn't even know what cost segregation. I had another client last year who came to me, had 56 rental properties in Indiana, had never done a cost segregation in any of them. We were able to do it and go back. So all these strategies, you can go back to most of them, but this is why planning is really important if you decide to have a business. From the beginning, you should treat real estate investing as a business. It's not a joke, because look at all these tax write-ups that you can do. If you were to get audited, because everyone here gets scared, oh my God, I'm gonna get audited. Unless you're laundering money or you work for the cartel, it doesn't really matter why you're gonna get audited. You just have to have really good records. It's a pain in the butt. You have to pay your attorney and your CPA a lot of money. But if your records are fine, play the game.